Crude oil has fallen once again. WTI is now back at about $83 a barrel, down from $106 just last week. Gold is now climbing back up, inching towards $4,900 an ounce, and the S&P 500 it has now closed above 7,100 points. The S&P and both the NASDAQ have closed near record highs. Is risk sentiment back? And if so, what does that mean for precious metals? Gary Wagner, editor of thegoldforecast.com, joins us once more. Welcome back to the show, Gary. And I'll encourage people to watch Gary's last interview with me, linked down below. He's been successful in calling for gold's rally, and he's been pretty much spot on with calling for levels all throughout the year. It's good to see you again, Gary.
Thanks so much. Great to be here. And really, really interesting times, especially with typical relationships that we would have with crude and gold. We're not seeing that. We're actually seeing the opposite. And that's what makes this such a fascinating time to be involved in the markets.
Gold acting like a risk-on asset, going up alongside stocks and going down whenever oil spikes. It's been climbing up precisely because tensions in Iran have de-escalated somewhat in the news, and the WTI price, like I mentioned in the introduction, has come down. So this is crude oil, and you can see there's been an inverse relationship between crude and gold. Can you just explain why throughout this year, and especially since the beginning of February, gold's been trading alongside stocks?
Yeah, it's not explainable in terms of a common sense or a typical A plus B equals C reaction. Because a spike in oil price happens to greatly enhance inflation or the chance of higher inflation, when we see crude oil go down, we would expect the opposite. Lower crude should take gold with it lower, but that's not the case. We're seeing an inverse reaction to crude oil right now. And I think it's the uncertainty factor more than anything else. If the truce holds, if we see the Strait continue to have free passage, I think we will see a normal relationship between crude oil and gold kind of emerge, not the opposite.
What does a normal relationship look like?
Well, normal relationship is higher crude oil, tends to lead to more inflationary pressures, and that provides bullish headwinds for gold. The reciprocal is also true. If we see oil going down, it tends to provide tailwinds to gold, stifling the upside move. And so when I say we're getting an inverse relationship, we're getting crude oil going down and gold moving up. That's typically not what we see. We also have to add tremendous dollar weakness, not today, but over the last couple of weeks, we've seen it move from about over 100 on the dollar index to about 96, 97. That's a 3% decline in the value of the dollar when compared to the basket of currencies that compose the index. So you've got that push-pull happening, and both are remarkably gold is very, very sensitive to moves in both.
You were on the show March 20th, and at the time we were discussing gold's decline from $5,200 all the way down to $4,100. Gold fell 21% in a span of just less than 2 weeks. And shortly after you were on the show, gold had bottomed out around $4,000. It's now back up above $4,800. That's an increase of 18% in a span of, again, another 2 to 3 weeks. 3 weeks. So gold has recovered a significant portion of its losses since mid-March. Has gold found a bottom, Gary?
Well, the way I've been looking at it, for lack of a better term, is to use my Elliott wave count. And so when I look at my chart, we had the all-time record high that came in on January 29th, above 5,600. We then got our A wave, and that moved down to 46.74. Our B wave back up to 54.65. And the low that you're referring to at 4,100 is the conclusion of an ABC correction. And if you think about it, In Elliott wave count, you've got a motive phase, waves 1 through 5, where 1, 3, and 5 take you in the prevalent trend direction, which were absolutely up. In fact, gold and silver both moved up tremendously. And when I pull up some charts, I'll show you what I noticed with silver outperforming gold almost by 50% or greater. But typically, when we have a market that reacts in this way, in other words, goes to a new all-time record high, it is not unusual. In fact, it's almost warranted or expected to see that cool off. Now, we had a tremendous rise because the rise itself was from, and I'm going back to the middle of August when
Right.
gold was at 3,400 up to 5,600. And the fact when it came down, the low was just below a 61.8% Fibonacci retracement of that move. And so looking at it in that way, in terms of a textbook uh, trading model that's using Elliott Wave, it acted as it's supposed to. Now, why that happens is another thing, because what Elliott Wave is able to do is to look at the psychology and market sentiment and kind of push away other variables that we tend to focus on. So the best way that I've described that correction after hitting the all-time record high was an ABC correction, and we'll point that out when we pull up some charts.
Yeah, please. Let's take a look at a chart, and I think traders and investors would like to know the next key levels. We are approaching, gold is approaching close to $5,000 an ounce once more. And I'm wondering two parts. One, if we can expect to see that happen by the end of the month or anytime soon. And what happens once gold retraces $5,000 again?
Okay. My chart
Yeah.
should be up. This
Yes.
is a simple daily candlestick chart, continuous contract. And if you notice, I've got this big black line here that starts at 3,400 up to the all-time record high as a basic Fibonacci retracement. So when you get a move moving from 3,471 to 5,600, the expectation is to have a sizable correction. So it came down at first, and this is what we label as our A wave, to about $4,460 right in that area. From there, we got our B wave. A B wave is typically 50 to 70% of the move down is recaptured. Then in a pure what's called a zigzag, which means the ABC has the B that comes about 60% of the move down in the A. The C is the final move and it comes in lower. We had your classic ABC correction. I believe that in terms of this model, that ended our correction, and now we have just we've restarted the clock with a new motive phase, and that's going to be composed of 5 waves, which we are now in our primary first wave. That's a benchmark wave, so it's harder to categorize where that will fall. Once we see that secondary B wave, second wave come in, then we're able to really model out where gold should go to. But if gold reacts true to form for what we're witnessing following the Elliott wave structure, the fifth wave would have to, by the actual way the model works, would have to be above this fifth wave, which is the all-time record high. So longer term, and I'm looking at maybe 3 to 4 months out, as this structure completes, we've got our 1, 2, our 3 should take us above 5,200, a fourth wave, and the final fifth wave needs to conclude above 5,600. And that's what's exciting. I think we're headed there, but realize it's not going to be a parabolic move up or down. And we will see corrective waves 2 and 4 in between that move. But I truly believe that we will conclude, I would say over the next 4 months, above 5,600. It could be 6 months, it could be shorter. Elliott wave does not account for time in the same way it accounts for price points. And so that's where that model tells me gold is headed higher. Now, short term, we could be hitting a top roughly in this area. But because the first primary wave in an Elliott wave count is a benchmark wave, until it's over, we can't figure out where wave 2, 3, 4, and 5 are going to go. We can conclude the fifth wave will be above the last fifth wave, but because it's a benchmark, we can't categorically say that it's over until we see that V formation where we're getting gold to move to a specific high, but then come down to form that V structure, which tells a technical market analyst that a pivot has occurred and that we've seen a reversal in trend short term.
Before we continue with the video, let's talk about a topic that's been on a lot of precious metals investors' minds: how to generate income with your gold holdings. Most assets either generate income or rely on price appreciation. Gold has traditionally fallen into the second category. Our sponsor today, Monetary Metals, has found a way that lets gold do both. Instead of just holding gold and waiting for price moves, investors can now earn a yield on it paid in physical gold. Through the leasing platform, investors can earn up to 4% annually with yield paid monthly in ounces. That means your holdings increase in gold over time. The metal remains in your asset base and can be redeemed at any time. Thousands of investors are already earning monthly interest in gold through Monetary Metals, so visit monetary-metals.com/Lynn in the link down below or scan the QR code here on the screen and make the most out of your gold today. Which do you think has a higher potential of reaching new all-time highs this year, gold or silver?
I think both of them will achieve that. When we look at some charts, I'll show you why I believe that. Okay. But they're running in a very similar manner in terms of my Elliott wave count. Both gold and silver are experiencing a correction right now. As I said, that's that ABC we talked about. Silver did the same thing, and it's also in its the primary first wave, in other words, a new part of a motive phase. What's interesting is the performance of silver during the big rally, and that's the rally we looked at on this chart from roughly August to the all-time record high, came in 29th of January. That's precisely what we saw in silver, moving to a new all-time record high above $120 per ounce. And I would have never thought we would see it this quickly, but we did. Now we have to take that information and restructure our model to account for silver's incredible move to the upside.
Gold has, in the last 2 months since the beginning of January, or middle of January rather, it's fallen by the order of 12 to 15%. Actually, no, close to 20% on 2 occasions in a very short amount of time. When an asset like gold, which has traditionally been very stable in price, has this much volatility, not just once, but twice in this short amount of time, what does that tell you about the market overall? What does that tell you about how traders and investors are feeling? Do you think the price is broken somewhat?
No, I think that we're in an environment in which the variables that gold is sensitive to, uncertainty being number one, of course, crude oil and the dollar, but the fact that it went to an all-time record high in January, and then the best way to explain it is technically, as it fell down, was a classic A, B, C correction. And if you look at this chart, really, we had a wave one that came in July, took gold to 36.21. The wave two was a small but effective correction, 34.35. And then when we had this third wave, and that's always supposed to be the longest, we get a 3. That goes up to 4,500. Wave 4 takes it back to 4,000. And then we get a fifth wave. And then we get an extended fifth wave because typically this wouldn't repeat. But this was the near parabolic move, taking gold from about 4,400 to 5,600. When you have a market that moves up that quickly and that much, you can expect the corrections to mimic that. And that's why we saw the severe sell-off. The trouble I had at the conclusion of the fifth wave was that this A wave, going from 5,600 down to 4,400, occurred over it's a daily chart, 3 trading days. Typically, it takes much longer than that because if you look at the B wave, there's probably 3 weeks of trading or close to a month. It concluded on March 3rd and it began really on February 26th, so about a month. And then the C wave also took some time from March 3rd down to March 23rd. So it's this A wave when there was a virtual meltdown. We saw that in gold and silver, specifically Friday the 30th, in which gold opened at 54.50 and then closed at what, 40, 49 and change. That's a tremendous move in a day. It's one of the most sizable downside moves we've ever seen in gold. I believe that it holds the record for dollar moves. Percentage gains we've seen close to this, but the dollar move was ridiculous on that day. So that is not what we typically expect out of an ABC correction. 3 days for the A wave to complete with such a huge drawdown percentage-wise from where it was to where it went on the A wave. However, when you hit an all-time record high like 5,600, it is not unusual for there to be a steep and quick decline as it moves into a corrective phase.
Mm-hmm. I'm not a technical expert, but just looking at that chart, it looks to me like a classic double top formation. You have a sustained high volume upward move that peaked not once but twice around a similar level in a very short amount of time. And then what followed was a breakdown in support. And then now it's trading around, it's trading sideways. Does this look like a double top to you? And if so, what typically happens after a double top?
Do you mean by the double top at above 5,600 and the lower high at 54?
That one.
That to me is not a double top.
Okay.
A double top would be if the next top was close to this one. You've got a low that comes in, then you have a lower high, and then you get a lower low. So when you get an all-time record high, you get the first wave of the correction that was steep, but then when it went back up, you had a lower high, and therefore this is not a double top. It is a lower high than the previous high, and then a lower low than the previous low, which is why it's fairly easy in terms of explaining it through an Elliott wave count. When you consider the move, because this starts our count at 3,400, and so you've got waves 1, 2, this is 3, 4, and then 5, and then we restart to get to this primary fifth wave. That's a tremendous move in about not a half a year, but a long period of time, middle of August to the end of January. Moving from 34 to 56 is what, $2,200? That is a huge, huge move. Silver experienced the same kind of move in terms of percentages. And so the fact that we had the steep decline that we label as an A, this B in terms of Elliott wave comes in structurally right on the money because it's about maybe a 65 to 70% move from the move down. The C is a classic zigzag because the C wave is supposed to be the lowest in terms of a correction. We can look at the fundamental events that occurred, and sometimes they match the standard correlations we look at. Sometimes they don't. But if you look at it straight through an Elliott wave model, and I know many have an issue with that, Elliott wave or technical analysis, but the results are the results. It did correctly predict many things that occurred over the last 6 to 8 months.
Silver price, is it still following gold right now, or has silver started to find its own way here? Let's take a look at the silver chart.
If you look at the gold chart, now I'm going to shift to silver.
Okay.
Which I've just done. As you can see, starting about the end of October, silver's at $45. In terms of the Elliott wave count, it concludes, and then this is also a fifth wave here. So you had that all-time record high, but The interesting thing is the move that took place during this entire rally was 165% gain. A total of $75, $76 was gained on this rally when you consider silver was at 46 and goes to 120. And just as we saw in gold, David, following that, we had a pretty steep ABC correction. So from 120, silver moves down to 63. That's our A wave. Our B wave goes from 64, 63 up to here. Now, this move here of the B wave, if you recall with gold, it was much closer to the highs than silver. The C wave completes a classic zigzag because what you're seeing is the C wave being the lowest value of the correction and the conclusion of the correction at that low, which is why we label this as a new motive phase, meaning the count restarts, and we are like we are in gold in our primary first wave.
Can we take a look now at oil and see if oil has also broken out, or broken down rather, and has broken below a support level and is now on a bearish trend?
Well, obviously, the all-time record high came in right above 119. That actually is interesting because this is being labeled as a fifth wave. Then we have our A wave. That's okay. Our B wave, though, is almost at the all-time records high, so it's an extended B wave. And the C wave should conclude well below the A wave, which it currently is. And if you can see, this is a Lux Algo Elliott wave, which is provided by TradingView, and it actually plots it. I'll look at that and see if I believe that's correct. And then when I hand draw it in, I will put in where I see variance or where it should be. But you can see this X here. And what that's saying is that's where we should see oil go to. The low today was right above that. And if that's correct, I would expect it to bottom out somewhere in this area and move back into rally mode or a primary first wave. So we have seen not an exact correlation. We see a really strong correlation between gold and silver. But here's where it gets interesting. Typically, if crude oil goes down, the relationship between crude oil and precious metals is lower crude oil prices diminish the possibility of inflation moving higher because crude oil accounts for so much in terms of inflationary pressures because of the utilization. Our economies are petro economies. And so to see crude oil move down the way it has, roughly from 117 to a low of $79 today, and this is a daily chart. So we had a huge meltdown today, breaking below this support level that comes in around 87, and it's based on these bottoms here. It tells me that what we witness with oil moving lower, but gold and silver moving higher, is not what we would expect in terms of direct correlations between those two asset classes, the precious metals, specifically gold, as a safe haven. But it's not been reacting so much as a safe haven. It's been reacting more like a stock does. And that's the interesting quality of the markets we're witnessing. My belief is if everything was that cut and dry in terms of the models I present and
That's right.
the asset moving exactly in the same way as we anticipated it, there wouldn't be much of a trading market. Trading will always keep us on our toes. Any models that we use effectively need to be proven right. In other words, lagging behind that. But we're seeing interesting inflections in gold prices in relationship to crude that we wouldn't normally expect to see. And to me, that's what makes this more interesting.
Let me share my screen for just a minute now, Gary. This is the oil price, WTI. It goes back to 2018 in this particular chart. I'm going to overlay this with a Fed funds rate. What you can see is that since 2018, not only has there been a correlation, but it seems to me that oil has been the leading indicator for what the Fed is going to do with their monetary policy. All throughout the 2020 to 2022, the oil price has been rising ahead of a Fed funds rate hike in 2022, which, by the way, caused pretty much all markets to fall in 2022. And then the Fed funds rate started falling after the oil price already started falling. So the question really is on everybody's minds how long oil will stay persistently high. Because right now we see this big bar. That big bar is oil jumping up, spiking up, but the Fed funds rate hasn't moved in either direction to reflect this change in the oil price yet. It's to be determined where oil goes next, but according to history, if oil stays high, we're looking at not only no cuts, but potentially a hike in the Fed funds rate. What do you think?
Mhm. Well, I think that's precisely what we would expect to see to some degree. In other words, the Fed is always reacting to information available about inflationary pressures. One of the greatest commodity, meaning oil, that is sensitive to inflation is the cost of oil. If oil goes up, inflation typically follows. And if inflation follows, the Federal Reserve will act accordingly. So that's why we've seen oil go up tremendously, and we are expecting a interest rate hike and to have that hike at the next Fed meeting.
Yeah.
So the Fed is always reacting to the information and it lags behind real time, but it is reacting just as you've shown beautifully on that chart that the moves by the Fed happened after oil did something. And when it moved higher, inflation moved higher, and the Fed did a typical response, higher inflation. You're typically looking for the Fed to either maintain current interest rates or raise them. And the expectation now is for the Fed to raise them. And it's occurring after a tremendous spike in oil. Even though oil is going down now, they're reacting to the spike when oil went above 119 per barrel.
I know this next question is difficult to answer. Nobody knows, but what do you think is going to happen to the price of oil? How long will it stay high? And by high, I mean post Iran war prices above $60 a barrel.
Put me in the nobody knows category, but if pressed for an answer, the key right now is not supply. We have plenty of supply. We have demand, but it's if the supply can get through, especially the Strait of Hormuz, which accounts for 20 to 25% of the world production of oil, getting to India and China specifically. They're the primary producers for China and for India. So if the strait supposedly reopened, we have a 10-day truce. If they extend that, or if they resolve the issue where oil flows freely through the strait, we will see oil come down because oil moving up wasn't a matter of it not enough being produced. It was a matter of not enough being delivered. And so if the question is, will it remain at its current level? I think it will move lower. If your question is, will it go to $60 or back down, it's back below 100, that's going to be determined by if the oil being currently produced can get through the strait, if the oil being produced is effectively getting to the countries that utilize it. If that's the fact, we should see oil come down.
You're based in Hawaii. It's a place that's heavily dependent on shipping prices for the cost of goods. Have you noticed inflation spike up in anything that you've consumed or paid attention to since the end of February?
Well, Hawaii, if if you want it, you got to bring it here. Is
Yeah.
the adage, and even our electricity to a fault is created here by burning oil. They're trying to move to solar, but they haven't fully moved there. So we are highly dependent on oil on this island. And so it affects everything. I believe gas is above $4 or 4.40. That's high. I can tell you a gallon of milk has gone up tremendously, but it's always been high here because if we need it, we got to bring it in to serve, especially Oahu with almost a million individuals, we're highly dependent on our shipping coming in and giving us the goods and services we need. So yes, we have noticed it here. Electricity is really, really high. That's gone up tremendously. I don't feel it only because I've been using solar for about 3 years. My entire roof is just filled with panels. But I do know what my friends and neighbors have told me, and I see it reflected in a little bit in my electricity bill, but I'm highly subsidized by solar on my roof. But yes, oil has moved up tremendously. And since everything we do, our electricity being the major component, is derived from utilizing oil, yes, we notice it.
This is from Reddit, the Hawaii subreddit. Does anyone have insights when the shipping shortages are expected to hit Hawaii? Are you concerned about any shortages in anything that you buy? Have you noticed anything of that
I
sort?
have not, no. I've not noticed anything. That doesn't mean that I'm I'm not that aware of the potential for shortages. Of course, they can occur, but
Hmm.
we've had the products we need coming into the islands unfettered for as long as I've lived here, and I've been here
Hmm.
25 years. The difference is how the price will spike tremendously and then slowly come back down for certain things that there are delays on. But because we are so dependent on ships coming in and bring us the products that we utilize but don't produce, and that's probably 80% plus of the products we utilize on the island, we are sensitive to that. You will see spikes. There was a recent spike in eggs, milk a couple of years ago, but historically, you have to be of the understanding that anything that we buy in Hawaii is more expensive than probably anywhere on the mainland, if not equal to some of the areas that have extremely high prices, such as West Coast and gasoline and things of that nature. But we're used to that. We know that we live in a very, very isolated part of the world where to get to any other continent is a trip of 2,500 miles, whether it's Japan or whether it's the mainland, whether it's Australia. We are
Hmm.
literally, when you look at a map, in the middle of nowhere.
All right.
And so that has costs, and we're basically used to those costs because we've come to expect them. So, does it shock me? No. Does it affect the pocketbooks of many of the civilians living in Oahu? Absolutely. But we live on an island. If we don't make it, we've got to import it, and we don't make a lot of things here.
Well, Gary, I appreciate your updates. Thank you very much. And as always, please follow the channel and subscribe if you want to see more daily updates. Gary's last interview with me is in the link down below, so you can check out his last call with me on March 20th. Gary, tell us where we can find your work.
Well, thank you so much. Thegoldforecast.com is our devoted website. You can read our commentary every day. Premium members can view our daily videos, and all people that have not signed up for that can view the videos that are about 3 days or older. And then we have a YouTube channel, The Gold Forecast, and that has about 2,500 to 2,700 videos posted from 2010 to current. We
Wow.
use that channel as a depository for all of our videos. And so you can see a tremendous amount. Not that you want to go back, but if you're curious as to what I said during the peak in 2011 or the fall to 2015, you can see how right or wrong I was in my forecasts. So that's really the best ways to become more familiar with my work.
We'll talk more about trading at another time. I'm curious to how you adjust your approach every time you are wrong, as it happens to everybody, and what we can learn from that. So I encourage everyone to check out Gary's website. In the meantime, thank you so much, Gary.
My pleasure as always, David.
Thank you for watching. Don't forget to like and subscribe.